I run a long short portfolio, stocks, bonds, currencies, commodities. What I find interesting, I don't want to be self-serving here, so I talk about my model, but I have to. So I created the inflation, deflation, and economic cycle model because I'm not smart enough to understand how to do this on my own volition. I needed to find a way of reading the footprints, the trades of the handful of oligarchs that run this planet. It's all insider information. That's why the market, the market's not some enigmatic force that that's bull. It is, the market trades on insider information. So if a general knows they're going to start a war and they buy gold and they short the market and they buy energy, that's just one example. Or if someone inside knows that, well, let's just stick with that one example. Look at the run up of oil stocks leading up to this war. And then when the oil stocks peaked, when the bomb started flying. I mean, why would that? It was a massive move higher in energy prices when no one knew what the hell was going on. I am not an inflationist. I'm not a deflationist. I'm just saying that I'm just reporting the output of my model. We were in a very big inflationary bubble, which a problem that I depicted months and months ago was going to happen. And now I'm saying the next few months, we're going to see prices fall pretty quickly, I think. If you look at the CRB index, if you look at oil energy prices, if you look at the 5-year forward inflation, we're seeing I'm not saying prices are going to crash down to 2%. I'm just saying they're going to go from 4.5 back down to around. That's all I'm saying. But that's on a second derivative basis. That's a pretty big drop. Is that the 5-year forward?
No, this is CRB.
CRB index. Okay.
Yep.
I don't know if you have the 5-year forward. I could show that to you, but share screens. Sure. It looks very similar to that, Dan. It's the same thing. So people who are listening to Kevin Warsh and saying, "Ooh, we've got an inflation problem and the Fed's going to raise rates a lot." I don't think they're going to raise rates, if maybe once, if at all, because I think the data coming out in the second half of this year is going to say, oh, we don't have, if you look at home prices, they're leveling off and real estate's a big component. Energy prices are really on the second derivative basis coming down sharply. Commodity prices, same thing. So it's not a deflationary situation. It's disinflation, which is a mathematical term that says the rate of change of the rate of change, second derivative, is going to fall from, say, 4.5 to 3. That's all I'm saying. And that means a lot to investment. That means those people who've been selling gold and silver, especially gold, might want to look at it again before they panic. That's all I'm saying. As a matter of fact, if I wasn't talking to you right now, you know what I would probably be doing?
Probably putting on a trade.
Buying mining stocks, because I think that the gold price could have a rebound here. And since gold miners use a lot of energy to mine stuff out of the ground, right? To mine the ore out of the ground, their costs are going to come. So I might be buying it. I might, not a promise. For me and my clients, might be buying energy stock. So they know this is happening. So they're rather than being, when the music stops, they want to make sure they have a seat. So they don't want to be, whoever's in that chair, whoever's seated in that chair doesn't want to be blamed for creating a transient, cutting, acute, protracted depression, which is what this would be when the music stops. It's not going to be a small contraction in GDP, and here's why. Like I said, asset prices are so inflated. So just be specific. If you look at total market cap of equities to GDP, it was about 140%. That's the highest it ever was prior to a recession, leading into the NASDAQ bubble.
Right.
Excuse me. So leading to the NASDAQ bubble, 140% of GDP. Prior to the global financial crisis, it was like 104% of GDP. Now it's 230% of GDP, 233% of GDP. At the last time I looked at it, which was yes.
There it is. 200.
So that's, Danny, that's 100 percentage points more than it was at the prior peak in the NASDAQ bubble.
Yeah.
And please, I always say this because some idiot was out there saying, well, this Buffett indicator is no longer relevant because U.S. companies produce things overseas. Well, yeah, that's true, but overseas companies produce a lot of stuff in the United States. That's why GNP and GDP tend to walk lockstep. There's not much of a difference between gross national product and gross domestic product. So this is a very relevant indicator, and it shows you how over financialized this economy has become. So they know two things. They know two things. Let me make this very clear. If you get nothing else from this interview, the level of which asset prices are going to fall, and you can put the home price to income ratio up there too. The level from which asset prices will fall this time around is absolutely record-breaking, record-shattering. That's one. And number two, instead of being able to ameliorate the issue very relatively quickly, which means years, and stopping the decline down, say 50%. Okay, look at that. That's a record home price income rate, even higher than it was in the housing bubble.
Yep.
So they understand that not only the crash going to be so intense because of the level of which asset prices are falling, but when they come to the rescue, and I'm sure they will, Danny, I'm sure the Fed is going to launch UBI, universal basic income. I'm sure there's going to be some kind of helicopter money. Deficits are going to be going from $2 to $6 trillion per annum. They understand this. That's due to the automatic stabilizers which kick in, which is, like I said, unemployment insurance, tax receipts go down automatically, SNAP programs, WIC, all those automatic welfare. They all kick. It doesn't have to be voted by Congress. They automatically kick in. Deficits are going to go to $5-6 trillion per annum, and that's starting from 123% debt to GDP. So we can no longer allow on saying, oh, we're just going to add to that debt and deficit by printing trillions of dollars of helicopter money and having the Fed buy it all. Inflation will go bonkers. The dollar's going to crash and the sovereign treasury market is going to crash. So bond yields are going to rise most likely, which is completely the opposite of every other instance that we've had a recession. Bond yields have fallen because we had a low debt to GDP ratio and we didn't have an intractable inflation problem as we do now. So that's the reason why the Fed is panicking already and why no one's going to preemptively hike interest rates a lot or really shrink the balance sheet a lot because they'll engender such a collapse like we've never seen before. What they're going to do is going to keep printing money until the bond market collapses. And until that happens, I'm going to stay long the stock market. But when it does, when the insiders know that's happening, I'm going to jump on them, sell, short the market, go long the dollar, go long the short end of the bond market because the Fed's going to drop rates to zero. And then sit back and relax. Kevin Warsh, who I had hoped or maybe maintain some vestiges of hope still, is an Austrian economist and he knows about money supply. He knows about the balance sheet. He knows that inflation isn't caused by growth or low unemployment rate. Inflation, as he says correctly, is a choice. It's a choice that Mr. Powell made to an exponential degree. I mean, this man missed the Fed 2% inflation target for well over 5 years and didn't care. He was lowering interest rates into that, which I think is disgusting. He also oversaw the increase of the balance sheet by $5 trillion. So it is a choice. Warsh knows that Powell maybe knew it, didn't avow it. He was like, oh, wow, temporary, transitional or transitory, whatever the hell he's. So, but Warsh, I had hopes for Warsh. Warsh knew that inflation's a choice. Warsh knows inflation's a choice. He's avowed that stance. And he knows inflation comes from the Fed's balance sheet. It's all about the balance sheet. It's all about the Fed creating high-powered money, which is handed to banks, and banks use that to expand the broader monetary aggregate. That's how inflation gets going. And of course, you can circumnavigate the banks by just, running up debt and handing people checks and having the Fed monetize that debt. You could do that too. But so this way you don't have to worry about if the bank's going to make a loan. They'll just send you a check to the Treasury, called helicopter money. They did in COVID. And then the Fed monetizes that, which is what they did. So I had hoped that Warsh would come out of the gate saying, we have stopped the increase of the Fed's. We're going to scarce reserves instead of adequate reserve or abundant. He said a week ago that he is going to expand the Fed's balance sheet by $10 billion per month. And what I found really disgusting is that he actually, after he took the helm of the Fed, he's already expanded it by $14 billion in a week, which is more than 10 in a month. So I'm really disgusted that he did. Now, he says the Fed's going to get inflation to 2%. Maybe they will, maybe they won't. I mean, we're lapping tariffs. We're lapping we're taking away a lot of the oil price increase. So maybe we will get back to 3%. I don't know about 2. But I'm personally very disappointed that the Federal Reserve won't shrink. Forget about stop the growth of the balance sheet. I'm very disappointed the Fed will not shrink it, at least not. The Federal Reserve knows that the next recession is not going to be a recession. It's going to be a depression. That's why they're willing to pump in trillions and trillions of preemptive dollars credit to make sure we don't ever have a drop in asset price. The over-financialization of this economy and the level of asset price, the historic level of asset price valuation, I'm talking about real estate and equities primarily, is so off the charts that they understand that we're not going to have, if we have just a normal run-of-the-mill contraction in the economy, it is going to make home prices drop by 25, 30%, and the stock market drop by 50 to 80%. They understand that. And they understand how devastating that's going to be. how much of this economy, in fact, almost all of GDP growth is, AI investment, right? They understand when that ends, and it will, they can't keep this going forever because the bubble in the bond market is going to force them to stop that. It's going to force a contraction in borrowing upon that AI investment bubble. It's going to happen no matter what the Fed does. But they know once the economy contract, the government balance sheet is so impaired that the balance sheet of the federal government cannot bail out the system. So in other words, last time we had a financial crisis, the national debt to GDP was like 63%.
Right.
Now it's 123%. We've added $25 trillion to the national debt just since COVID. We have $2 trillion deficits as opposed to the last time we had a recession when the deficit was like $200 billion, $300 billion.